So good afternoon, everyone, and welcome to this webinar. So today we're gonna reveal the secrets of Elliot Waves. I'm Johnny from the research department in Oxford. We'll start with a small introduction about how to be a profitable trader. So there's four main things to satisfy. The first one is the fundamental analysis. And when we talk about fundamental analysis, we mean by it the main macroeconomic variables that affects directly the market and give me a vision about where the price market is going. For example, the main aggregate will be the GDP, the CPI, or the reports that measures inflation. I have the unemployment rate, I have the interest rate. So for me, I have to understand how each report can affect directly the market. And this will represent around 20% of a profitable trader. The second thing is the technical analysis. And I mean by that, like the chart analysis, the price action, the indicators, my support, my resistance, and all these factors that I can clearly use and see on the chart to get my entry point. And this also represent around 20%. The third one is the risk management strategy. So like, for example, I would take like one trade per day. I can't lose more than 2% of my capital. I have to control my trades, so I don't go with a revenge trade. And these also represent around 20 to 25%. But to be a profitable trader, the main thing is to know how to control my emotion. And basically, this is the main crucial pillar. So when I say emotion, there's no big loss. I cannot do big loss. Even I will do like big win or small win, it's a B, or a small loss. So controlling my emotions and knowing very well myself and my character into trading, this is the main thing. And this will represent around 40%. So technical analysis, when I say technical analysis, I mean by that the price action strategy, engulfing, morning star, evening star, other candle, and all of these like shapes that I can clearly see on the candles to have my entry point, to determine my entry point. The second one will be the chart patterns. So I know my support, my resistance, my supply zone, my demand zone. The third one will be the indicator, like for example, the A50, the RSI, and the final one will be like statistics. So how many buyers I have now on this day, how many sellers I have on this day. So let's start with our main important thing for today, and it's the Elliot Wave. Ralph Elliott is who created the concept of Elliot Wave. For him, the market moves by directions called Elliot Wave. Like this analysis, it's a very advanced and pro analysis. And if there is anything in the market that can predict the price, it's the Elliot Wave. The Elliot Wave can be used in two types of markets, the bullish and the bearish. I will start my first example with the bullish candle. So I have firstly to start from the bottom of the move. So the market will make its first move called wave 1, followed by wave 2, and wave 2 will be a correction of the first wave. Then he will make the third wave, then a correction of it for it called wave 4, and to end with our fifth. So 1, 3, and 5 will be called impulse waves. So these determine the direction of my market. Wave 2 and wave 4 are called correction waves. And these will be the correction of this wave. Like for sure, there's some rules, but we will discuss them later. But usually, to use Elliott wave, I have to start with my first impulse, then correction. Then the third would be impulse. Then the fourth will be correction. The fifth will be impulse. And then after the market makes these 5 waves, he will make A, B, C, wave A, wave B, wave C, and the 3 of them will be the correction of the Elliott wave. Like that. So now I will take the example of a bearish Elliott wave. So I start from the top of the move, and then I will have my first bearish wave, followed by a correction called number 2. Then I will have my third one called number 3, followed by the fourth. It's gonna be a correction, and to end it with the fifth one. And now I have my first part of the Elliott wave. Second, I will have my A, B, and C. Definitely, we will have some examples later. So just like it's a small introduction about Elliott. So the rules are the following. Each impulse wave is followed by a corrective wave. So one is followed by another corrective wave or correction wave called wave 2, and then should be calculated by a certain amount using Fibonacci, and we will check it later. Usually, we have 5 waves. As we said, we have wave 1, wave 2, wave 3, wave 4, and 5. 1, 3, and 5 are called impulse move or impulse wave. The 2 and the 4th wave are called correction waves. 1, I have the wave from 1 to 5 completed. Then I will have my correction wave called A, B, C, as I showed you before. So let's take a small example about it. So we'll have first move, corrected move, third, fourth, fifth, and then we'll have A, B, C. Like there's some rules that should, like there's some golden rules that should be applied if I have an Elliott wave. The first one will be wave 3 shouldn't be the shortest impulse wave. So in another term, I can say that wave 3, if you remember, so we have, we'll throw it again, 1, 2, 3, 4, 5. So the third one should be the longest among 1 and 5. Rule number 2. Wave 2 should not surpass 1, the first wave. I mean by that, like the low of the second wave should not be there. Because if it's here, then my Elliott wave is incorrect. Third one will be that the bottom of the wave 4 shouldn't be higher than the top of wave 1. I mean by that, like the low of the fourth wave shouldn't be below 1. So below the support made on 1. So I can't notice an Elliott wave. So to notice it, I have to see like 0, 1, 2, and then a breakout of the support made by the first wave. And then after that, like I can think about a possibility that I may have an Elliott wave. So to draw an Elliott wave, we'll start from the bottom and we go up the bottom of the move. We'll check an examples later on. We'll start from the top and go down in case of a bearish trend line. If the trend is bullish, we call wave 1 an impulse wave and wave 2 the correction of it. And the top of the fifth should not surpass the trend line from 1 to 3. So with that, like I can draw the trend line from the highs of 1, 3, and 5 should not be there. Okay, and corrections wave 2 and 4 can be estimated using Fibonacci. Can you explain about Fibonacci retracement? And I said yes, for sure. So our Fibonacci retracement is used to predict the levels of the third, the second, the third, the fourth, the fifth wave, and we can predict A, B, C as well. And we will see how. Fibonacci noticed that there's some key levels, or there's some golden levels in the market that can be used to predict the correction. Before going to the market section, he noticed that, like, if I have the arm of a human being, I will here have the elbow, and I will have here the wrist, and I will here have the hand. So the part from the wrist till the hand represent around 61.8% from all this setup. So it's the same analysis for the star. The dimension of the star represent around 61.8% from all the diagram. So 61.8 is my golden level. We will see how we can use it in the market, but I want you to remember these levels later on. Okay, so we use the Fibonacci corrections to estimate wave 2 and wave 4. In order to calculate the third and the fifth wave, we use something we called Fibonacci extension. And I will directly jump to the market to take an example. So let's go ahead to the Australian dollar USD. And I will go, I think we will start from here. So if you notice, the market was going up, and then he made a small correction. So that point, for me, I can draw clearly my Elliott wave, because here I have a ranging market. It's not here it's bullish, but here it's ranging. So first, I will draw my Elliott wave. I go to that section, and I choose Elliott impulse wave 1, 2, 3, 4, 5. I start, as I said before, from the bottom of the candle. It will be my wave 0. I will go to the top of the wave before the correction. It will be wave 1. Wave 2 will be the correction of the first wave. Then I will have my, can put it here, if I want, I can put it here, I can put it here. This is my third wave, followed by the fourth wave, and to end by the fifth wave. Now I will go to check if my rules are correct. So wave 3 shouldn't be the shortest impulse wave. So as I can clearly say, wave 3 is the bigger, and I want to be more professional, like I can do it like that. It will be like more visible if you want. So my first one is satisfied, my first. The second one is wave 2 should not surpass wave 1. As I mentioned before, wave 2 should not be lower than that line. So for now, my first one is satisfied, and my second rule is satisfied as well. Rule number 3, the bottom of wave 4 should not be higher than the top of wave 1. So this is the top of wave 1. So 4 should not surpass. Till now, I have a perfect Elliott wave. Then I will go to that section again. I will choose Elliott correction wave. I will start from the top of the fifth. I will draw my first bearish move, followed by a correction, and end it with the fourth move. So now I'm trying to show you like what the market did before as an Elliott wave. So we have to take few examples before going to something new. Here comes the exciting part. If I want to measure the correction of the second wave, it should be determined by Fibonacci correction. So I go to that section here and I choose Fibonacci retracement. To know where the price can go or on what levels can the price stay, I start from here with the 0 and I go to the top of the first wave and I will have a click. I will zoom a little bit. So these are the Fibonacci correction. If you remember, the 61.8% and the 50% were our golden levels, and there's many more. There's like 1.61.8, we have 78.6, and we have here 23.6 or so. All of these represent the Fibonacci keys or the Fibonacci level. And if I can see the candle respected the 61.8 and it closes above the 50%. So till now, all my setup is good. So I will repeat that point. To measure the corrections, I will use the Fibonacci correction. To use them, I will go here to that section here, and I will use the Fibonacci retracement. I will start from the bottom called 0, and I will go up to the top of the first wave, and I click and zoom in a little bit, and I will see like that the candle respected 50% of the Elliott wave. So let's do then the correction wave 4. For wave 4, I will go as well here, Fibonacci retracement. I will start for that one from the bottom of the wave 2, and I will go up to wave 1. And if I can see, it's almost hit it 38.2 So for me, when I see that setup here, so I have the first move, I have the second move, I have the third move, like I can sell from here. I can sell from here as well. And my targets will be the first level, second level, the third level, and until I don't have a bullish candle, the price will continue to go down. So this is for the correction. I have also a small correction here called the wave B. And for that one, I will go again to the Fibonacci retracement. I will start from 5 and I'll go down to A, and it almost hit the 61.8%. So till now, my Elliott wave is perfect, almost perfect. Now, if I want to measure the third and the fifth wave, I will go to something we call trend-based Fibonacci extension. For that, I will start from 0, go to the first wave, and then go down to the second wave. So I will get that setup. For me, if I had my Elliott wave like that, I hit the target. It's almost hit the 61.8%. So that one here is correct, and that one here is correct as well, because all my rules are correct. So I will take that example now. So my first level after the second wave, so the second wave starts here and it closes above the high of the first wave. So now, like, I can know that I have an Elliott wave coming up. So I will buy from here, and my first target will be here. To be very honest with you, it's not here. That I don't know that the price will continue going up to hit these levels. So my target was here, but I can close some of the positions and take the rest as a runners. So that one here, I put in, and it closes around, it's between the 61.8 and the 61.8 on the second level. So this Elliott wave is very, very good. Now I will go to measure my fifth wave. I will start from 2. I will go to 3 and go down to 4. And if you can clearly see, usually that one, it will do 38.2 or 50% maximum. So it's hit the line 100%. It was punctured. So wave 2, wave 4 are estimated using Fibonacci retracement. The third one and the fifth one are used using Fibonacci extension. We'll take another example later on, no worries. But till now, like, this is Elliott wave. I will continue. We had our wave A for the correction. Then I can measure the B as I did before. We'll go to the Fibonacci correction from 5 to A. It's almost hit the 61.8%. And usually, not always, usually the currency formed something we called head and shoulders, and C will be the bottom of the head and shoulders, and I will show you how. So I will go here, I go to head and shoulders. My left shoulder starts from here, my head will be here, and my right shoulder would be here. I will adjust that one a bit. So usually I have a head and shoulders here. So I will measure it from here to here, and I will move it here. So see, it's a perfect Elliott wave. So C hit the target 100%. Or I can use another method, like as I used extension before. I will go to the Fibonacci extension, start from 5A and go up to B, and as shown, it hits the a level of it. But definitely here is not my first target. My first target would be, I think, here or here, and I can leave some runner for the rest. If anyone had some questions or anything, please feel free to send us a message on chatting. So this is Elliot Wave. It's used for estimating the corrections and the extensions as well, and the correction A, B, C. I will go now to a pair that usually formed and head and shoulders, and it's the Euro USD. So the Euro USD have a big one here. So it's an example of a bearish Elliott wave. So I will start from the top of the market. I cannot start from here. I cannot start from here, and I cannot start from here. Definitely here we have a ranging market. Here we have a ranging market. So after that, the bearish move starts. So I will go to my impulse wave. I will draw my first wave followed by a correction, and then I will have my third wave followed by a correction and end up with the fifth wave. So that one is long. It starts from February 2022 to September 22, and we are working on daily time frame. So it's a long one. Usually, each impulse move, we have like 5 waves in it. So we have 1, 2, 3, 4, 5. We have that. And each correction move, we have A, B, C. But if you go to lower time frame, you will see that that one represents by itself an Elliott wave, and that one represents by itself a correction wave. As well for that, the same analysis for 4, 5, and ABC. So when I finish drawing my Elliott wave, I will go to the correction wave ABC. I will start from here. I will go A, B, and C. Why I chose C here? Like someone would tell me, like, why didn't you choose here? Here is good, but here it's very close to A. And as I said before, the C usually will be the end of the head and shoulders. So that one will be at the same level exactly as 4. Usually it will be like that. So let's measure our retracements. So I will start with the correction wave 2, as I said before. I will start from 0, 1, and I will go to the right. If you can see clearly, it hits the 50%. That's a perfect Elliott wave as well. So it hits the 50% as well. If I want to measure the 4th wave, I will go from 2 to 3. Sorry, it's almost hit the 38.2%. So till now, everything is good. And if I want to go back to my rules, rule 3 shouldn't be the shortest. It isn't the shortest. Wave 2 should not surpass wave 1. Wave 2, it's higher than the first wave. And the bottom of wave 4 shouldn't be the higher than the top of wave 1. And the wave 4, it's much far from the first wave. So till now, everything it's perfect. I will show you the Fibonacci extensions. I will start with the 3rd wave. As I said, we go here, we go to Fibonacci extension. I will start from the top, go to the 1st wave and extend it to the 2nd one, and you will notice it hits the 61.8 sharp. That's what is beautiful about Elliott Wave. Like, this is insane. So if I notice that the market is going down and it passes the first wave, my target definitely, my first target will definitely not be here. Maybe it's gonna be here, somewhere here. But he did it, and then the price fall. So that's insane. Now we'll measure the fifth wave. We'll go again to Fibonacci extension. We start with 2, 3, and extend it to 4, and you will definitely see it respects again the 61.8%. Yeah, that's wow. Wave B will be measured by a correction Fibonacci from 5 to A, and that one can put it here. See, it's 78.6%. And then we have something similar to Head and Shoulders here at the bottom. So let me check if it is good Elliott Wave in Head and Shoulders. Yeah, definitely. So the extension will be from here to here. So I go to my arrow, bring my arrow, so it's gonna be here. We can put it here. We can put it like the first target will be, as I said before, like can be 4, and I extend it here, and definitely I will make some profit and close my trade with benefits if I notice that I have that one. So we gave an example about a ascending Elliott wave and a descending Elliott wave. I will go now to finish my session with an Elliott wave that might be seen on the euro dollar as well on daily time frame. So let's start to draw it. I will go to the impulse wave as well. I will start from the bottom of that move, start from the bottom of the candle. I will go up to the first wave, followed by a correction of the second wave. Then I will have my third, fourth, and fifth. After that, I will go to check or to draw my correction Elliott wave. It's gonna be A, B, and definitely C would be something here. So till now, I have everything excluding C. So you can save that chart and check it up later if it works or not. Like if I want to see my corrections, I will go from the bottom to the top, and it hits the 78 point. All my rules here are correct because 3 is the longest, 2 isn't below 0 or the first move, and was the third one. The fourth is higher than 1. So with that correction, it hits the first target exactly at 78.6. Then I will go to the second correction from 2 to 3, and it almost hit the first. It's hit the first target of the Elliott wave. It's at 23.6. So till now everything is good. Now I will check my extensions. I will draw the third one from 0, 1 and extend it to 2. So that one, for me, my first target will be definitely here at that level. So it hit it and it goes up a little bit. So for me, I close the trade here. Okay, then the price continue move, maybe due to fundamentals or some interest rate increase or whatever. Then I will go to my fifth wave. I start from 2, 3, and go down to 4, sorry. And if you can notice, it hits the 38.2%. Yeah, this is insane. Absolutely insane. So And I have now to check my correction wave B. It hits the 78.6%, almost. And the one and only C that I will draw it now, it will from A and B. It will be like that. Oh, maybe my first target will be here. So you can check this one after some time, maybe at the mid of this month. So definitely here will be my target. Maybe the price can stop here, but for me it's a bit, sorry, but for me it's a bit short. Why? Sorry. Go again. So I was saying, like, this level here is short for me. Why? Because based on fundamental analysis and based on some technical analysis, I can clearly see that the USD dollar, price of the USD dollar will increase sharply after a few months due to interest rate and due to the recession that's coming to Europe and to all this region. And the one that will benefit from this is the US dollar and is the pound. And the weakest will be the Australian dollar, the euro as well, and the yen. So you can search for an entry here to go and sell straight if you want. So basically, this is everything. So we have a question. Please, I want to ask you why Elliot Wave is forming. At which stage 1, 2, 3, 4, or 5 we should place our attention to set up a trade? Okay, so that's a good question. So once you have that setup here, so once you have the wave 1 and 2 form, and then the price, sorry, once you have 0, 1, 2, I will draw it again. So once you have here and the correction wave and the start climbing, and the daily candle closes before after the high or higher than the high of the first wave, you can start thinking of a probability of Elliott wave. So you can start drawing if you want, and you can check them by time. As I mentioned here, the C, like the time will determine. No, don't sell euro now based on this session. For sure, we are not here to give a signal. It's some prediction, like maybe the price will close above 5. Who knows? Nobody knows. But for you, if there's a possibility or a probability to go to the wave C, like you will be waiting for it and you will catch it directly if the price starts going down. So follow the news, follow your technical analysis, and you will see if it will hit it or maybe it will go up. You don't know. Like nobody knows. It's if you want some analysis, some future analysis. So that's it. If someone have any questions, please feel free to ask before we end. So I will wait maybe a couple of minutes. You want to think about something? Okay, meanwhile, I will also go to we have something. So if I notice I have a descending Elliott wave on the gold before, please feel free to ask if you have anything. So it's will be almost like that. That's a bearish Elliott wave on the gold as well, but it took time for sure. And if you can do you can do that exercise at home to start like the corrections and everything. So you can check the correction of the second, the fourth, extension of the third, and the fifth as well. Okay, so I think it's good for today, and that's it for now. So in this PowerPoint, like the same examples as I took before, but definitely trading are at the trading view is better. So I would like to thank each and every one of you for attending the session. We promise you that we will have more to come, including technical, including fundamentals. We have a question. We have to always use Elliott wave to analyze the graph. No, Elliott waves is a way to analyze. Like as I mentioned here up, you can use the price action like engulfing morning star, evening star. You can use the patterns, the triangles, the flags. You can use the EMA. You can use some statistics, but Elliott wave is a way to analyze, to do your analysis if you want. It's not always like if I will go to the one I just drew here on the gold. If you notice, like we are on March 2022, and it ended on November 2022. Meanwhile, you have 8-9 months. You can do plenty of trades. You are most welcome. So it was a pleasure assisting you. We promise you with another webinar very soon about technical fundamentals, risk management, and everything. I was Johnny from the research department, and thank you very much for attending that session.